Well, this is a very important video because in this video, I will teach you what trading is all about. When you are using my orange trading system, there will be times when you will miss huge opportunities in the market simply because the stock was not meeting our criteria. So let me explain what I'm talking about here. If you see this weekly chart base, this is Cummins India, and this is an old chart. So as per the SEBI regulations, we can discuss this. This was in 2020, just after the corona crash. It created a flat base. On this week, the relative strength rating of the stock was 52. So the stock would have never come in our filtered list. But if you notice, there is this flat base. The high of this base is 494. So I will draw a line there. 494. That was the pivot point, the buy point as per the weekly time frame chart. And at that time, this was 17 November 2020 when the breakout happened. If you see this, it broke out in that week. But if you go to daily time frame chart of this stock, 17 November. So this is 17th of November. Okay. You see the price is above the 50 day, the 50 days above the 200 day, and the 200 days above the 150 day. Moreover, the 200-day moving average is sloping down. So we don't have the blue, green, red combination. We have the blue, red, green combination. This is a non-negotiable criteria. So this stock violated two criteria, which I also discussed in the previous video. The relative strength of the stock on 17th of November 2020 was less than 70. It was 52. And on the daily time frame chart, the moving averages were not aligned in such a way that they met the Mark Minervini trend template criteria. So the price should be above the 50 day, the 50 day should be above the 150 day, and the 150 day should be above the 200 day. That criteria was not satisfied. So obviously we would have rejected the stock. But coming back to the weekly time frame chart, if you notice, the stock started going up from here and it never looked back. It never touched this price ever again. And by the way, if you observe the movement of this stock in November 2020, the price of the stock was approximately 500 rupees. In July 2024, the price of the stock was 4,100 or 4,000. Okay, roughly. It went beyond 4,000. So this is like 4,000 minus 500, okay, divided by 500. Percentage is 700. This is like a 700% return in 4 years. So the stock shot up 8 times to give a 700% return in 4 years. If you had bought this stock here, the stock never came back to that yellow line. So forget about your stop loss getting hit. The price never even came close to your break even point. Okay, if you observe the chart, you can uh, you can move the price forward because this is old chart I'm showing you. You can see the entire chart on your trading viewer market smith. The price went up 8 times in 4 years to give us 700% return. Now you might ask, Rohit, did we miss this opportunity? Now, remember when I started this video, I told you that I'm going to teach you what trading is all about. So listen carefully. You might think that we missed a huge opportunity here, but in reality, that is not the case because trading is a game of probabilities. The argument that I'm making here is if you start buying stocks which do not meet your relative strength and your moving average criteria, okay, if you start buying those stocks simply on the basis of market smith marking the base for you, what is most likely to happen is when you buy 100 stocks like that, each of those 100 stocks do not meet your relative strength or moving average criteria. When you buy 100 stocks like that, You will make money on some on you and you will lose money on some. But net, what is likely to happen is that the amount of money that you make from some of those stocks will not be enough to cover the losses that you incur on the remaining stocks. So let's say out of 100, you make money on, say, 30 or 40 stocks, and the remaining 50, 60 stocks or 70 stocks, you end up losing money because they were displaying poor relative strength and they were also not in a confirmed stage 2 uptrend. So chances are very high that out of 100, majority of them are going to be losers and minority of them are going to be winners. So the profits that you make on winners will not be able to cover the losses that you incur on your losers, right? Because they don't meet our basic criteria. So you don't have to look at a stock like this and conclude that you are making a mistake. You don't have a look at a stock like this and say to yourself that I should have bought the stock. In hindsight, everything looks fine. In hindsight, everything looks rosy. In hindsight, everything looks beautiful. However, if you want to put the odds in your favor, you have to buy leading stocks from leading industry groups with institutional demand, trading at near 52-week high, considerably above the 52-week low, and trading above the 50 and the 200-day simple moving averages along with the Mark Minervini trend template criteria. That's it. And having decent fundamentals. That's the formula. That's basically the criteria that we are looking for before entering a stock, because that is how you put the odds in your favor. So if you're looking at this stock and you're thinking that you missed a 700% return, you are not thinking like a professional. You are not able to think that if you had bought this stock, you could have bought 100 more stocks which were not meeting your RS rating and moving average criteria. And if you had bought those 100 stocks, you could have lost a lot of money on those stocks. And the money that you made on this stock would not have been enough to cover those losses. Correct? So that is one thing. Second thing, who holds a stock for a 700% return? You tell me. Okay, that's an investor, that is not a trader. During that ride, there could have been many instances where the stock closed below the 10-week simple moving average on high volume, which is a basic violation of our criteria. So you are never going to end up owning a stock for 4 years for a 700% return. Very few people are able to do that. Trading is not about buying the low and selling the high. Okay, trading is about buying the stock when it meets your criteria and selling the stock when it violates one of your basic uh, criteria or when it meets one of your sell rules. That's what trading is all about. You cannot catch the bottom, you cannot catch the top. Okay, that is not possible because you don't know the future. Okay, you might think that this is the top. You might think here that this is the top 600 is the maximum price the stock can ever achieve. The stock will never go beyond that price. But it went to 4,000. Check the chart. Okay. So please think in terms of series of trades. I encourage all of you to study the work of Mark Douglas, who sadly passed away few years ago. But he did a lot of great work in trading psychology. He taught me to think in terms of series of trades. So when I'm looking at a stock like this, I don't feel any regret because I know that anyways the stock would not have showed in my filtered list. So you can't buy a stock which does not show up in your filtered list. Okay? You can't lose money in a stock that you never bought. You can't make money in a stock that you never bought. So why would you want to think about a stock that you never bought in the first place? Why not think about those stocks which you bought and which met your criteria? Okay. Those are the things that are important. So, this is what trading is all about. It is a game of probabilities. You did not miss a big opportunity. It's simply the stock did not meet your criteria. And during this run, there could have been times where the stock did meet your criteria and you are able to extract like 30-40% return out of that 700. That's what trading is all about. Okay. If you could make that kind of a return from that stock, it's more than enough money to make from one stock. Okay. Thank you so much.